Good morning. Marc Ostwald from ADM Investor Services International. I was lucky enough this week to be invited to participate in a panel at the Institute of Directors here in the UK City annual forecasting event, and I'd just like to share a few slides from that about the global economic outlook, about the interest rate outlook, and about the risks there too. So my first slide is basically just trying to highlight that the US and China and indeed Japan are all likely to slow a little this year, but still be roughly in the ballpark that they were last year. Eurozone is going to be pretty lackluster yet again. Our key concerns, I think, remain the ones which were the big bugbears for the global economy last year, i.e. Germany because of the auto sector and the energy change. India also suffering in its auto sector, but more broadly due to non-performing loans, and Latin America, which was a very poor performer last year. The inflation outlook globally is basically likely to remain very, very muted by technology, by globalization, and indeed by demographics. Nevertheless, I think one thing which is important to bear in mind as we go into a new decade is another decade of gluts in the commodity and energy sectors doesn't seem to be necessarily that likely. And as a result, we may have a rather more volatile commodity and energy price outlook, above all due to protectionism and above all due to climate change and supply chain disruptions. So, next slide is a very simple one from Bloomberg showing the expectations, market expectations on rates. And really, I think the very simple message from here is that while there are a few countries where there is expected to be a little bit more further easing, we in principle are not looking for central banks to provide much in the way of stimulus. Which brings me to my next slide, which is about financial markets at the moment. I think the key difference between 2019 and 2020 is financial markets, because of the lack of prospects of any rate cuts and because we need to be slightly more optimistic with current valuations of riskier assets, are seeing the glass as half full rather than half empty as they did last year. They are very, very selective at the moment about which bits of the global economy reports that we look at. We're even riding fairly roughshod in the short term over the coronavirus outbreak in China. We really aren't sure what sort of impact that will have. I think there are nevertheless a lot of other factors which we need to bear in mind, which won't necessarily feature highly in financial markets. We've still got rising inequality. We've got an incessant rise in borrowing at government and corporate level, and a lot of financial engineering. And the political narrative in the backdrop that we've got at the moment is quite antithetical to innovation, from the sense that protectionism doesn't help. I think the other thing on the innovation side is people do really need to bear in mind that a lot of what we're calling innovation is just bearing down on labour costs. It does seem like it's going to be a better year for tech, but not necessarily the auto sectors. There's too many challenges related to emissions and climate change there. And on my final slide, I think the emphasis here is the fact that we are hoping for fiscal stimulus. We are likely to get it from China. We are likely to get it from the UK. We're definitely going to see some more from the US. But critically, it's what will happen in Germany, above all, to facilitate the whole climate change process that they're now going through. There is a huge need for infrastructure spending. Climate change considerations are going much more front and center. And I think above all, what we need to remember is procedure is cannot actually be a substitute for understanding the way that processes are changing, and we need to adjust those procedures accordingly. So it's going to be a year of change, I suspect.